Hey guys, Mr. Tweet back here with you again. So in this video, I'm going to be going over the supply of money, finishing off our money market graph that we started in the previous section. In the previous section, we learned about demand and how the demand, this is really the demand for M1, and this supply curve right here is the supply of M1. So it's not the supply of all forms of money in the economy, it's just the supply of M1, which again is cash and checking account deposits, that's what M1 is. So the reason why our supply is a vertical line, right? Again, because I said before in the previous video that our money market is really, it's like unit 2 supply and demand, but for money. The difference here is that when we talk about the supply of money, it's there. Not anybody who wants to can produce it, right? Unlike, shoes or burritos or t-shirts, where anybody who wants to can produce those things. Not anybody who wants to can make money. That's called counterfeiting, and it's illegal, sends you to prison for a long time. So, right, basically, there's only one entity that's allowed to make or create money in our economy, kind of, right? We'll learn later about how banks actually create more money, eventually, but don't worry about that right now. Really, there's only one body that is in charge of the creation of money. And you might be sitting there and you might think like it's the government. And it's kind of the government, but it's not the government you're thinking of. It's not the president. It's not Congress. We don't allow them to decide how much money there is in our economy. A little over 100 years ago, we took that power away from the president and Congress because we were afraid that they would manipulate the money supply to political ends, and we want the money supply protected from, those kinds of political decisions. The money supply is determined by this group called the Fed. It's like 14 former CEOs of banks and like PhD economists from the top business schools, Northwestern, Penn, Berkeley, Stanford, Columbia, MIT, the top economists in the United States and kind of former bank CEOs. They sit on this board, and their one job is really to determine how much money there is in our economy, what the supply of money is, which means that this supply, right? It's not an upward sloping curve because we just decide what it is. We just pick an amount of money, or I say we, the Fed, that's who decides how much money there's going to be in our economy. So the Fed determines the supply of money, and they can increase the amount of money in the economy. They can decrease the amount of money in the economy. How they do that will be a whole nother video, right? We'll get into that, later this week about how they increase, how they decrease the supply of money. For right now, I just want you to see that they can control the supply of money where supply meets demand. That gives us our equilibrium interest rate. So what we have here, right, lowercase I, letter E, our equilibrium interest rate. And then when supply shifts, it causes interest rates in our economy to change, all right? So we can see a couple of different shifts here. The first one is that if the Fed wants to, they can increase the supply of money. So supply shifts to the right. I get my supply of money 1. That leads to a new interest rate, which is lower. So my equilibrium interest rate has fallen. And this is incredibly powerful, important for our economy. Because if you can decrease the nominal interest rate, now you've incentivized people to borrow money that might not have borrowed money before, so they can do things like buy cars or buy houses or start businesses or expand businesses. So when we see the interest rate go down, right, supply of money increases, that's going to cause, right, when the supply of money increases, that causes my nominal interest rate to fall. When my nominal interest rate falls, that causes investment. That causes consumption. That causes investment and consumption to go up. Because when interest rates are lower, now buying a house is cheaper. Even though the price of the house maybe didn't change, your monthly payment is lower because the interest rate is lower. So now people can afford houses that couldn't afford them before, or people who maybe could have afforded it, but didn't want to spend that much money. Now they can buy that house and it will cost them less because of the lower interest rate. Or if you've got a business that you're thinking of expanding, right now, it just got more profitable because you're spending less money on a loan. That means more money you get to keep as a profit. So now you're incentivized to make that jump, expand your business. So when nominal interest rates fall, we see investment and consumption go up, which means aggregate demand is going up, so we can close recessionary gaps. So the Fed, by changing the supply of money, they can close recessionary and inflationary gaps, right? If they wanted to, they could do the opposite. They could decrease the supply of money, causes my interest rate to go up instead of down. So if the supply of money is decreased, nominal interest rates will start to go up. When interest rates go up, my investment, my consumption, those things are going to decrease because now, right, it's more expensive to get that loan to expand the businesses. So some of my business spending is going to slow down. My consumption is going to slow down because the house got more expensive, cars got more expensive. So as interest rates go up, we see the economy start to slow down, or at least spending slow down on the investment and consumption side, which means lower aggregate demand, again, closing my inflationary gap. So what we see here is our model of the money market. Supply is super important, right? There's this group called the Fed. They're like these economic experts that are they're nominated by the president. They're confirmed by the Senate. So the government puts them in place, but then once they're in place, they typically work pretty independent of the government. They analyze the economy, they meet monthly, they decide what they think, what's happening with growth and with unemployment and with inflation. They look at those three key measures and they try to decide, do we need to try to stimulate the economy a little bit? Do we need to try to cool it down a little bit? Or is it just right? And then they adjust based on what they find. So the Fed is this group of experts who adjusts the supply of money to try to fine tune our economy. If we're in a recession, they increase the supply of money, that lowers interest rates, creates more spending. If we're in an inflationary period, they decrease the supply of money, that causes interest rates to go up, and it acts as a cooling effect on the economy, cools it down a little bit, closing that inflationary gap. So that's the supply of money, super important. In the next few lessons, what we're going to get into is how the Fed actually shifts this curve, what they do to increase the supply of money or decrease the supply of money. Now, in your head, you're probably thinking, oh, they just print money or they burn money, but that's not exactly how it works. But that's, again, future video. So see you guys later. Peace.